recording this session. So, if anyone has issues with that, please let me know either privately in the chat or right now. And again, this is a fantastic panel. Ivan Niku put it together. We've got some really, really smart venture capitalists here. Brett Brewer from Crosscut. We've got Brian Lee from BAM, and they're just, they're legends in the ecosystem. So if you don't know them, now's the time to get to know them. Ivan's gonna start. Ivan's with Navigate. He's a close friend. We've got to know each other quite well recently. And I'm the president of this TCA chapter. So I'm very, very honored to welcome Ivan Niku. He's gonna present, and then he's gonna introduce the panelists and go through an e-commerce panel. Give us some good insight and hopefully help us not make some bad investments in this space. Thanks, Ivan.
Thank you, Sonny, and thank you so very much for having me again. Thank you, everyone. It's a pleasure to be at TCA again. I have had the pleasure of doing a number of presentations for TCA over the years, but it's always in person. But tonight we have a special panel, and this panel is going to discuss the evolution of e-commerce, social media, and other factors that are affecting it in a very strong way. And to do that, I am very, very pleased to introduce you to two of the most experienced and successful e-commerce executives in the United States. I've had the pleasure of knowing Brian and Brett for many, many, many years, and I'm truly, truly honored to call them friends and very close friends at that. These two gentlemen have played a very key role in the development and the creation of the technology ecosystem in Southern California for years. And their impact is enormous. But instead of me telling you about that impact, I'm going to ask them to very briefly introduce themselves and just tell us a little bit about their journey as to how they started and how they got here. And then we'll get into the details of what's going on. So Brian, if you'd be kind enough to get us started, tell us about your background, how you got started, the days prior to LegalZoom, and all the way to here to today and BAM Ventures.
Got it. So it's been a pretty long journey for me. I started life off as a lawyer. Started my professional life as a lawyer at Skadden Arps. And then from there, I started my first company called LegalZoom.com. Started LegalZoom out of my condo with almost zero capital. I think we borrowed about $50,000 from my parents and from my partner's parents. We actually pitched TCA. I'm not sure if you knew that, Ivan. But
I did not know that.
Time ago.
Did they invest?
No.
Brian, just to rub it in, could you please give him an idea as to what $100,000 back then would have meant now?
Oh God, I have no idea. I can't even do the calculation, but
billions.
I don't know. But we launched LegalZoom out of my condo, just kept growing it, and then about 9 years or 10 years after starting LegalZoom, I started ShootOusville.com with Kim Kardashian. It was an early kind of e-commerce subscription model. And then we sold that one to Textile down in El Segundo. And then I started The Honest Company with Jessica Alba and launched that probably, 6 years ago now, 7 years. And then started BAM Ventures along the way as well. And that's what I'm doing today.
Okay, this is the shortest version and the most humble version of Brian's background you could possibly imagine. Along the way, there have been many, many other successes that he's not referring to, but we'll just leave it at that for now. Needless to say, he's one of the nicest, smartest guys that I know, and he's really the cornerstone of e-commerce, not only in Los Angeles, but as a whole, because he was one of the first to start a subscription e-commerce, and he was the one that really brought this to the surface. So, Brett, would you be kind enough to tell us about yourself and how you started and where you are now?
Happy to do it and happy to be here. Thanks for having me, Ivan. So started pretty much about the same time as Brian, I think. I started in 97, attempted to pitch what was at that point the Angel Network, the Tech Coast Angels. We couldn't quite figure out how. I started that with my college roommate at UCLA, and we were, and it's relevant to the panel today, an e-commerce business, selling movies and music and games online. Very tough business. We competed with Amazon and CD Now and all those first iteration players, but because we were in LA and we sort of had a lack of funding, we were always like having to figure out things the inexpensive way. We went public in April of '99 and kind of rode that original .com wave into being.
What was the company called?
The company is called eUniverse. We renamed ourselves Intermix Media. Sorry, I should have said that. So that was my first business, Intermix Media. Really started in e-commerce. We weren't the smartest guys, so it literally did take us 2 to 3 years to realize selling someone else's product at extremely low to negative margin, we were never going to win against Amazon and these others. And so we actually ended up selling the e-commerce business off in 2000 after the .com crash. We started launching casual gaming sites, low cost content sites, and then eventually we started MySpace in the summer of 2003, which became bigger than anything we had ever done, and got into a fortunate situation by the summer of 2005 when Viacom and News Corp both kind of wanted to own that asset and own Intermix, and we sold to Rupert Murdoch and News Corp in October of 2005. I then spent 6 months there working for Rupert Murdoch and actually working on a bunch of their e-commerce projects, and then joined an existing business called Ad Knowledge, raised money from Technology Crossover Ventures for Ad Knowledge in late 2006, and we scaled that business quite quickly and then sold the majority of it to TPG and a group called JMI and Nokia. Along the way, raised money from 8 venture capital funds, none of them in LA, never even really pitched an LA venture capital fund. So that the concept behind starting Crosscut in 2008 was start a fund in the Los Angeles market, a seed stage $7,500 million fund focused on the LA tech ecosystem, because the thesis was there was going to be a lot of amazing companies generated over the next 15, 20, 30 years, which certainly I think we've all seen in LA. It's been an incredible market. We're now investing at a Crosscut 5, $100 million fund. We make 30 investments per fund. Seed stage fund, we made 115 investments over the years. Some of them have worked, some of them haven't worked. I see we got a lot of investors, few investors on the panel, but it's been an amazing journey. We've really followed e-commerce all the way. I do think of Brian. It's amazing that Ivan was able to get Brian. I do think of Brian as being an icon in the e-commerce category, and morphed where I got so burnt out early on that I took a 5-year hiatus. I didn't want to invest in e-commerce for 5 years. And now I've sort of come back and seen the light in certain cases.
Well, gentlemen, the two of you are truly the stars of our community, and not just because you've been successful, but because of everything you've done for everybody else. You've always been there. You are very generous with your time, your advice, and your capital, and we appreciate it. So, Brian, if you look at when you started, I remember when we discussed Shoot-Dazzle it seems like about 30 years ago. There's a lot of things that have changed. If you fast forward, when you did Shoot-Dazzle, customer acquisition was easy. Tools were not easy. You had to develop in-house. Now everything is readily available off the shelf. Tell me about where you think the changes have come, and where were you then and where are we now?
Oh boy, that's a great question. And it's amazing how fast everything changes, right? Technology is growing at an unbelievable clip right now. So even, I mean, I'll even step back to LegalZoom and back then, because that was early in e-commerce, e-services. But I remember how expensive it was to start LegalZoom, right? And literally, I remember we bought a web server. It was a Dell Blade web server, and it was like this thing. It was like that, and it cost like $250,000 for that one server. and I remember it's like even finding talent in this city of Los Angeles was really, really hard. I mean, I think we found the only person we knew like who could actually build a website. He was at Sapient. I'm not sure if you remember Sapient, but he was at Sapient, and he did it on the side for us as a side hustle. But I mean, so much has changed in terms of platform and the availability. I mean, it costs nothing today to launch, you know, an e-commerce site if you wanted to spend nothing. I mean, it's Shopify, a couple graphic designers, you're off to the races. That didn't exist when we started LegalZoom, especially Shoot-Dazzle or even The Honest Company. Like The Honest Company, we had a whole team. We had a team of, at one point, probably 35 engineers, all building the platform, which in today's world is just not necessary,
Yeah.
right? I mean, there's so many tools available that you can build off of now, and it's yeah, it's just it's the cost and the time to launch a new e-commerce site is almost nothing. It's all
So on
brand.
that note, if I may continue on that, Brian, if the cost has gone from extraordinarily high to almost nothing, it essentially implies that anybody can create an e-commerce company, potentially even a brand or whatever it is. What are the positives and negatives of that? If somebody wants to start an e-commerce company right now, knowing this, what should they know?
Well, number one, it's a lot more competitive, right? I mean, if you think about how many brands are now being launched, and I can't even keep up with them in Los Angeles, right? I mean, there's literally so many e-commerce companies that are launching. And don't forget how easy it is to sell on Amazon as well as some of these other platforms. So if you're starting an e-commerce brand, even a direct-to-consumer brand, I mean, there's a lot of different channels that you can use, from your own Shopify site to Amazon to whatever it is. There's so many ways to distribute the product. So that's the advantage is that it's easy. The disadvantage is it's extremely competitive and very difficult to rise above the noise, if you will. And
Does that mean your customer acquisition costs go through the roof?
uh, partly, yeah. I mean, cost per acquisition on any of these channels have gotten very, very expensive. And it's almost a competitive moat for those who started before, which is why, anytime a new kind of platform starts rising, that's as an e-commerce, person myself, is like, I'm always paying attention to what's next in terms of platform, because that's the cheapest time to advertise on that new platform.
I'm going to get to that, but I'm going to ask you a question. We had this conversation when you started the Honest Company about how much does it cost to establish a new direct-to-consumer brand online. And back then you said something like 30 to 40 million, something, if I remember correctly. What is it now?
Gosh, it's to establish. It depends on how quickly you want to go as well, Ivan. Right? The Honest Company, I mean, we put the pedal to the metal on that one, right?
Yeah.
But if you wanted to build a brand over time, it doesn't even cost nearly that much. You can just kind of build it over time. But depending on how fast you want to grow, if you wanted to kind of replicate what we did with the Honest Company today, I'd say the cost would double.
Double. Okay. So it's gone up a lot. So Brett, as you've been kind enough to come and guest lecture at my classes at USC. For those of you who don't know me, in addition to running Navigate Ventures, I'm a professor at USC Marshall, and I teach classes on venture capital, private equity, and of course, e-commerce. And both Brian and Brett have been kind enough over the years to come and speak in my classes. So Brett, the joke that I have with my students is whatever I teach you this semester, by the end of the semester is completely obsolete anyways. When you're looking at assets today, what do you consider favorable assets to invest in when it comes to e-commerce or adjacent to e-commerce? And what do you consider not favorable assets to invest in? So where are the areas that you might consider and where are the areas that are just no-nos and why?
Yeah. Well, the one thing we know, and everybody on this call is an investor and a lot of great investors here, is it's not so much you can invest in a business that's going to grow, but you got to invest in a business that's going to grow and generate enterprise value and eventually have some sort of exit. So one of the things that's always scared me about e-commerce, and it's very true today, and Brian touched on it briefly, but is the lack of defensibility. So besides the fact that there's so much competition that your customer acquisition costs are going up, the other thing is your ability to protect prices is going down, because either you're selling something that is working and then lots of other people see it and are selling knockoff products or very similar things and eroding your margin, or you're selling something that's not working and that's not good either. So I guess to start with the negative side of the equation, what we try to avoid is selling anything that just has lack of defensibility, because as a venture investor, you got to think 3, 5, 7, 8, 9 years
Yeah, but you have to explain what that means. Lack of defensibility. What does that mean? You're selling third-party products. You're selling what?
Well,
Be specific.
selling, yeah, very specific, yes. So Honest Company is a great example. I think they just filed to go public, and the reason Honest Company is able to file to go public, that's right. It's great for LA, great for Brian, great for Jessica, and it is because they built a brand. You heard him say they spent $30 or $40 million building that Honest Company brand that has value. They've developed their own products. They've developed their own messaging around the product. That's what's creating the value there, right? There are lots of Me Too companies selling lots of products. As a matter of fact, we have one actually. We have a great company. I always say companies can be great as long as you know what you are, but we have a business called Boosted, which is a guy named Charlie and Keith here in LA that are rolling up Amazon third-party reseller businesses. And you wouldn't necessarily be blown away by the products, but the products are successful Amazon product store that think of a couple that developed a couple different kinds of soaps, and they've been selling, and they do $1.5 million of these certain soaps. They have 8,000 positive reviews about their soaps and this and that. They've really kind of carved out that little market for them. This company Boosted, which is based in LA, is rolling up those businesses, basically buying them at 2, 3, 4 times EBITDA, and in theory as a bigger entity with economies of scale valued at much higher than that. So in that case, it is actually, we did make an investment in a business that is acquiring products that on their own, maybe you wouldn't even remember them per se, but because of the moat that they have with the reviews, there's value there. But to hit your point, Ivan, as a venture investor, you have to have something that's defensible. Honest Company, the brand is defensible. In the case of Boosted, their M&A strategy is arguably defensible in the way that they're integrating these companies. But e-commerce or not e-commerce, there has to be something there that will stand the test of time and ultimately translate into enterprise value.
But so somebody comes to you with yet another direct-to-consumer brand right now selling pet products.
Yep.
Do you consider that?
We do consider it. I mean, it is our job. You hear me say it. It's our job to hear the pitch. Probably it's a pass. What we wouldn't.
Why?
On, because going into you heard Brian say it again, another very good thing. There's a big advantage for existing incumbents, at least on all the existing platforms. So if you take where Brian sold Shoe Dazzle to, the person running that business is named Adam Goldenberg, my very good friend and longtime roommate. We worked together at Intermix. He was our head of e-commerce. Adam has such a big advantage now. They own Just Fab, Shoe Dazzle, Fabletics, Savage, the Rihanna brand, you name it. You go down to Manhattan Beach and you see their sophisticated army that they have on pricing, on product. To think that you're going to launch another Shoe of the Month club and go in there and know the landscape of where to acquire customers, the remarketing strategies, the pricing advantages in China that they have, it's just not going to happen. So sometimes the entrepreneur doesn't know that because they raised $750,000 from their uncle and their cousin, and they got big eyes and big dreams, but they will eventually run into those kind of headways. So in that example, another pet toy company going into an existing category with strong incumbents is an immediate pass.
So Brian, let me ask you this question then. First of all, would you be kind enough to tell everybody about BAM Ventures and BAM Labs and what you do? And then let me ask you the same question. What sectors are in favor now? If somebody comes to you and says, Brian, we are a few people, we've got experience, we can count to 10, and we can, walk and chew gum at the same time. What should we do in e-commerce? So tell us about BAM Ventures, BAM Labs, and what sectors do you believe that in the coming months and years have a chance of succeeding?
Sure. So BAM Ventures is a small kind of venture fund. We invest early into entrepreneurs. So we're pre-seed and seed stage investors. We write small checks. Right now, we're writing $500,000 checks into the earliest stages of businesses. We focus on 3 different sectors, all consumer related. So we are a consumer firm. The first bucket is consumer brands. So is that me echoing? Sorry.
Yeah, it's you.
Sorry. Hello?
Yeah.
Okay. So the first is your traditional consumer brand plays. So apparel, beauty, food,
So
dogs.
exactly what Brett said you should not do, you like to do.
We love it.
You can do it. You can do it if you're really good. I mean, the truth is you can do it if you pick really well.
Yeah. The second bucket is consumer, more kind of what we call consumer tech. So it's any kind of technology platform that needs consumers to grow. So think like esports or video gaming or social media. These at the end of the day need consumers, right, to become of scale. And the third category is SaaS software, but it's software that helps to enable commerce or retail. So those are the three sectors that we focus on. And the answer, or I totally appreciate what Brett's saying. There's a lot of venture capital firms that don't touch e-commerce at all, actually. So Crosscut's one of the few that actually does actually look at e-commerce. And the reason is it's hard. It really is. It is very, very difficult to build a brand.
It
Right?
didn't
And
used to be. Now it is.
yeah, here's the thing though, Ivan. I think it's always been hard.
Hmm.
It's like it's always hard to build a brand. It takes a lot. It takes time. It takes money, and it takes extreme diligence in your promise to your consumer, right? And delivering upon that promise over decades, right? To build a brand, right? And I always like to say that a brand is something that really it resonates with the consumer beyond the product, right? So the example I always say is this one Nike commercial. Nike is probably one of the greatest brands ever to exist, right? And I remember watching this Lance Armstrong commercial, right? This is before Lance Armstrong got into trouble. This is when Lance was at his peak, right? And he was on a bicycle, and he's cruising down the Swiss Alps or French Alps maybe, and he's not saying anything. You just hear him breathing, and you hear the wheels churning, and they zoom in on him and zoom out and zoom in and zoom out, and at the end it's just the Nike swoosh that says "Just do it," right? And I was like, wow, that's so cool. It inspired me to want to start biking. So I go to the bike store, and I go to the bike store and I said, you know what, I'd like to buy a bike, and I want to buy a Nike bike, right? And they looked at me and said, Nike doesn't make bikes. And I go, what do you mean they don't make bikes? I just saw a commercial with bicycles and Lance Armstrong. Yeah, they don't sell bikes, and they're not really, they sell a couple like, Nike shoes for bicycles or whatever it is. But that's what a brand is. A brand will make you want to buy something they don't even sell, right? It's like just the promise of what they want you to feel.
But how do you know when you meet a brand new team that the potential of that brand exists?
For us, it's hard to describe it. It's like, the old adage, like you'll know it when you see it. I kind of feel like that happens with brands. It's like for me at least, it's kind of I'm not sure if it comes naturally or whatnot, but I cut through a lot of that and I go right to the story. Like, why does this product exist? Why is this the entrepreneur that's going to bring it to life, right? Why is this going to stand above the fold? And I'm a big believer in brands. If brands didn't exist, I mean, who are like nothing would exist, right? If there's no innovation in brands, then nothing would be innovated on. Yeah. So I believe that we live in a time where brands can still be launched and they can still get to scale. Even if other dog toy companies exist, other dog toy companies will take the place of the other ones. Right?
So we're not going to ask any more questions to Brett, and we're going to concentrate on Brian for the rest of this conversation, because clearly Brett doesn't know what he's talking about. But Brian, you didn't talk about BAM Labs, because you do incubate companies and build your own as well. Can you talk about that, please?
Yeah, so very quickly, I'm sorry, Brett, I'm taking up all the airtime here. BAM Labs is kind of a production studio where we launch businesses out of. So it's a partnership that I have with Lightspeed Venture Partners, and we've launched 3 companies out of BAM Labs so far. One is called Art of Sport, that we launched with Kobe Bryant. It's
Sadly.
yeah, but you know, amazingly, it's doing pretty well, right? It's doing pretty well as a brand, and we're growing it. The other is called Seventh Spark Church Home Global, which is an online church. And the third is called Eliza Technologies, which is technology that focuses on Ganimation, which is general adversarial networks.
Okay. So Brett, let's talk about valuations and market trends. So I come to you with my brilliant e-commerce idea, and what do you want to see before you actually invest as far as traction is concerned? And if you do invest from a standpoint of, let's say, seed, not necessarily pre-seed, seed standpoint, what are the check sizes? Where are the valuations? Where's the market?
Sure. So good example, we looked at this business, unfortunately we passed, but this Pop Shop Live business, when it came through LA, doing quite well. But what we saw there, I think is a good example. So whether it's a company selling a physical product or Pop Shop Live is a platform, basically like a home shopping network, but much faster. We want to see the same thing, which is for Crosscut, we want to see that the business is working.
What does that mean? What does product market fit mean? What does
product market fit to me? Product market fit to me, and we just did it again, by the way, with Picasso, the second home ownership, which is really an e-commerce business if you think about it.
It completely is, yes.
Yeah. So I'll use that as an example. But I think there's product market fit when we can see. Doesn't have to be a ton of data, but it can be 250, 300, as little as 250 or 300 customers, and seeing what their order repeat rate is, what the CAC to get them is, what's your cost to produce the product, sell the product, etc. The point being, you know, compared to BAM Labs or other versions, there's lots of entities that will, on a business plan, invest and say, I think you can produce this. I think this can become a thing. For the Crosscuts of the world, we are sliding to the right and saying, we want to wait and see that there is indeed consumer demand for that product. Or
if there is. What is your check size for a company like that, and what kind of revenues do you want to see for that company?
You know, the revenues depends on the product and everything, but let's call it $100,000 a month, roughly, in revenues, 50 to $100,000 a month. The average round today is something like a $3 million round at a $10 million valuation.
10 pre or post?
10 pre.
You're kidding me.
No.
Wow.
And the average valuation of Crosscut 1, which was admittedly 2008, which in some ways doesn't feel that long ago, but I guess it is. But the average valuation was somewhere around $4 to $4.5 million valuation. So it doesn't take, you can sort of see it's basically 2.5 times is more or less where the market has shifted. There's obviously a lot more venture capital firms. There's a lot more dollars in the market, but it's a great time to be an entrepreneur. I think those valuations are probably too high, and we'll see over time, but that's where the market is. And from there, a business, there's really only two outcomes from our $3 or $4 million round. Either we're correct, and typically the business grows very quickly, as we saw with Picasso. We're now in 20 markets. And for those of you who aren't familiar with the business, it's basically democratizing second home ownership. You can look on the app. It's a Zillow-like interface. Find a home in Park City, in Palm Springs, and buy a quarter, a sixth, an eighth of that home literally on your phone.
And what's the valuation of that business now?
We raised money at $1 billion plus.
After how many years?
After 5 months.
Yeah, I mean, that's ridiculous. I mean, does that even make sense to you?
It does, because of the size of the market, and because the business is working, and because I'm an investor. But it really is a huge market. I mean, ultimately, what venture capitalists are looking for are incredible teams, number one, but building businesses to disrupt massive large markets, and arguably Picasso can do that.
Let's call that an outlier. Let's say the company is a typical company doing typical e-commerce. Let's say direct-to-consumer brands. You come to you, you do 3 on 10. Now the company is doing 20, 30, $40 million. Where are the valuations there?
It's two to four times revenue. It's one of the tough things about e-commerce is you have to raise a decent amount of capital.
Yep.
And every time you raise capital, it's expensive.
And
So
what do you do with the inventory situation? If they actually have to carry inventory, and I know Brian went through that with the Honest Company, and
yes.
I'm going to ask you both this question. If you're going to give advice to someone that's going to run an e-commerce company, how do you manage the inventory question?
Well, and I'll weave in, and then I'll let Brian answer. But this move around headless commerce is sort of a buzzword, and to ramp everybody else up in a sentence or two, it's basically the concept that all of the tough parts about e-commerce that Ivan just mentioned, the credit card tracking, the fulfillment, all that stuff can really be outsourced now to Shopify. Yep. And you can plug in. So you plug in from your social media site, you plug in from a connected car, you plug in from your smartwatch, and all the company has to worry about is making a nice user interface. I'm going to shoot that dog in a second. Don't worry about that.
It's your dog?
But, yeah. But that has made it much easier for companies not to have to worry about just what you said, Ivan. I mean, that's what took us down and really made e-commerce so hard was the inventory and the returns. Yes. The returns in the old days were 25-35% returns. We would die on that.
So Brian, same question, please.
Yeah, so inventory is what kills any business in commerce, right? Too much inventory in anything. So it's nothing new. Again, I harken all the way back to the 20s, the 30s, the 40s, the 50s, all the way to today. Inventory has always been a problem, right? For any brand, for any business. And so it's nothing new for e-commerce. Maybe the returns are a little bit higher. So you have to price that into the product, right? But in terms of inventory, it's a process, right? You really have to understand what demand planning is. You really have to understand the S&OP process and really have to have the right demand forecasting. Otherwise you're upside down, and you could go upside down very quickly. And without enough capital, if you make too many mistakes, you're done.
Right? So a lot of companies, I'm sorry, Brian, I didn't mean to interrupt. I apologize. If you recall with Honest Company, you decided to actually have the retail channel as well with Costco and the rest. So I've seen that with a lot of smaller e-commerce companies, and when they do that, it kind of kills them. What are your thoughts about being direct to consumer as well as having the retail or wholesale, or whatever you call it, the Targets and the Costco's of the world?
I don't think there's I really don't think there's any difference in today's world when it comes to building a consumer brand. At least and it took me a while to get to this place, right? Because before I was so all about direct to consumer and all about e-commerce, that e-commerce was going to, change everything. And if you're going to start a brand, start online. It's a lot easier and faster, and there are so many advantages to it. But in today's world, what I realized, and the Honest Company is what helped me realize this, was that at least for the Honest Company, it was a very mission-driven business, right? We were out there to truly create a non-toxic world. And in order to create a non-toxic world, we had to be in people's homes. The product had to be in people's homes. So however they shopped, whether it be direct to consumer on our own website at honest.com, or whether it be Costco or Target or wherever they shopped, we wanted to be there because we would make it into their home, right? And what that helped, after we launched into Costco and after we launched into Target, we noticed our e-commerce numbers took a huge hit, right? It got more and more expensive to get people to shop at honest.com only, right? Because now they have the option of going to Whole Foods or wherever else we were. But you just have to kind of model that into the entirety, as opposed to we're just an e-commerce brand or we're an offline retail brand. In today's world, you got to be both. You got to be everywhere.
I do agree with that, but from a business model standpoint, on the direct to consumer, you get paid first before you ship out. Whereas with Costco's, you got to send them all your inventory, and God knows when the hell you're going to get paid, and the margins may be less. And that's why I am asking you, at what point in an e-commerce life cycle, e-commerce company's life cycle, do you believe it's the viable thing to do?
I actually think it's viable a lot earlier than you would think. Because the cost of acquisitions online are so high in today's world, right? What you want to do is you want to launch the brand, you want to burn the channels as fast as you can, right? So when I say burn the channels, I'm talking the lowest hanging fruit.
Yeah.
Google search, Instagram, Facebook, all the lowest hanging fruit. You want to get to efficiency, right? So basically, efficiency is probably you want to pay that cost per acquisition up to the point where you have at least a 1-year payback, right? You don't want to go above. Initially, you want a 3-month payback, 6-month payback. You can stretch it to a year over time. You don't want to go above a year, and then you want an LTV of about 4-to-1, right? Ideally, right? And so once you start seeing those kind of metrics, you're already fully efficient on that channel. At which point, where are you going to get the growth, right? You got to go offline, right? Or try something else, which is why you're always constantly looking for new channels to advertise on as well to reach efficiency.
So Britt, I'm going to ask you the same question from a valuation standpoint, because we've looked at e-commerce companies that are more retail than direct to consumer versus the other way around. And the direct to consumers tend to carry a higher valuation than the ones that are more retail. What are your thoughts? What are your recommendations?
Well, the one thing that surprises people, usually e-commerce companies aren't as profitable as people picture, right? It just is. And because you end up typically plowing back any margin that you have into customer acquisition. So I know I was on the board of PacSun for 10 years. We looked at buying 2 or 3 of these PacSun competitors that were online businesses, and they'd be doing 150, $200 million in revenue. And everyone at the board level will be very excited. I would say, I can already tell you that business is breaking even, and then lo and behold, we get into it, and sure enough, it's breaking even. So that is always an overhang on valuation, I guess, that it's just very hard. I mean, look at Amazon. Clearly Amazon made it in a big way, but it takes years and years and years to hit that. We've seen that with Fabletics, one of our businesses down in with Kate Hudson's the face of it, a yoga brand. They've now kind of broken through and are the leader and now can defend margin, but it's an overhang on valuation, truthfully. The valuations are very reasonable in the e-commerce category all the way up through exit.
So Brett, this question is to you and to Brian as well. When you look at your companies and as they grow, who are the best investors for the next stage of the life cycle of these e-commerce companies? Because are they in LA? Because there's not that many investors in LA. Who are the investors that people should go to if they want to discuss e-commerce and get investments?
Yeah, I know Lightspeed is a great e-commerce investor in the Bay Area. Upfront has plenty of e-commerce stuff, I think. And the good news now when it comes to capital sources, there are, and this includes Crosscut, there are so many venture capital funds. If you can with a good business, you can be really picky about who you're bringing into the cap table. What I would look for, to your exact point, is what are they going to bring? Like what expertise, what experience are they going to bring in scaling this business, and how does that differentiate from the other capital sources?
Brian, same question, please.
Yeah, I totally agree with Brett. I mean, there's plenty of capital out there and plenty of firms that don't shy away from e-commerce and from brands. Brett touched upon a couple of them. Lightspeed is a partner of mine. You have General Catalyst, Andrews and Horowitz, Sequoia. I mean, they all invest in e-commerce. You got to get to a certain point to capture their interest. But at the same time, for the right e-commerce plays, there's a lot of capital out there.
How about the earlier stages? Call it, I'm either seed stage or maybe A round or something like that. Who would be some of the 4 or 5 players that come to mind?
Forerunner does tons of e-commerce. Series A.
Yeah, I think Forerunner, Band Ventures, Clock Tower, and there's a few kind of around the area, whether it be Silicon Valley or down here in LA that invest in e-commerce.
Any investors in Los Angeles or Southern California that come to mind other than Brian and Brett? Because my fund doesn't do it. We only do enterprise size.
Jonathan over here They invest in e-commerce. I know that. They love brands. Um, who else? Jonathan, why don't you chime in? Who else is out there investing in
Should I list
brands?
every fund I'm in? Let's see. I
Yeah.
mean, besides you guys, I mean, like,
M13, yeah.
Jesse. I mean, Jesse does. Jesse Draper. She's
Sure.
consumer e-com focused at Allergen. It just depends. I mean, like, look, like,
We're getting a lot of good ones on your chat here. M13, I love those guys.
Yep.
13, of course.
Halogen Ventures, yeah. Right. All these guys.
Brett and Brian, a question has been posed. When you have a number of very highly qualified, experienced, and well-to-do individuals in TCA, how could they possibly work with you two and others in Southern California for potential investment opportunities?
One big one, which, I see a lot of friendly faces. Crosscut generally is an open platform. We love having big events. Obviously, COVID has made that more difficult, but soon, hopefully, COVID will be in the rearview mirror. So a big one I always love is sending us your companies that you're excited about, that you've invested in, and let us lead that next round with you. Let us, we'll go a little earlier, even occasionally, and a little later. But deal flow, it's the easiest way to work together on something.
Brett, may I share your email with everyone on
Of
this?
course. Yeah. It's brett@crosscut.vc.
That's it.
I'm going to tackle this one right now. Ivan, any thoughts on SPACs? We have 4 or 5 portfolio companies that are being pursued by SPACs. We have 75 portfolio companies, so that's not surprising. But as it turns out, I'm sort of the lead board person in negotiating with these SPACs. It's an amazing invention. It's an old invention, but for all the reasons a lot of you probably know, it's sort of right place, right time. And these SPACs there are hundreds of them. They're incredibly aggressive for a variety of reasons. They don't really need to have they don't need to get in conflict with the company almost when setting the price. They can sort of agree on a valuation, and then they go back to the pipe market. And if they can sell it, they're just as happy as the target company. There was a big accounting change actually that got announced last night, that the SEC announced. The way warrants are going to be accounted for is a big difference in the SPAC world, and it's sort of reverberating through, and it's going to make existing SPACs, it kind of creates some issues with them, and some ways they're going to have to re-report. So I do think it's here to stay. I don't think the SPAC world goes away. It's really just a different way to look at your last couple of rounds of financing, private financing and going public, all rolled into one, and doing it in a short amount of time.
There's a question on Coinbase. Thoughts?
I mean, I'm bullish generally on the category. I'm sure the valuation is going to be extraordinary. But I always like to find things like that. I like to find categories and companies with wins at their back. I still like Google. I still like Facebook. I still like Netflix and Amazon. You just think about the next 5, 10, 15, 20 years. I think that same thing applies to Coinbase. I think Coinbase has a lot of room to grow.
Brian, thoughts?
Yeah, big fan of Coinbase. I would be a buyer even on their IPO, and it's going to be an extraordinary IPO. I don't even think it's really an IPO; it's more of a direct listing. But on SPACs, similar thoughts to Brett. I mean, I think they're here to stay. I think it's I think right now, look, I have more friends with SPACs than friends with COVID. And so there's a lot of SPACs out there chasing a very small amount of great deals. So there will be a shakeout, right? There has to be. But at the same time, those that survive will be stronger for it. And I don't think SPACs are going away. There'll just be a shakedown, a SPAC squeeze, if you will. But yeah, but Coinbase, I would be a buyer.
What are the best tools currently for someone that wants to start like Shopify-like tools? Can you ramble out a few that that people can take advantage of?
What? I'm sorry. Say it again.
Tools to launch what?
E-commerce tools like Shopify-like that you encourage your companies to use, or maybe you can send me a list and I can share with the group.
Sure, I'll send you a list.
All right.
There's quite a few. That's why. It depends on what you're looking for, Ivan. But I can give you a list of all the tools that we look at.
That would be appreciated. So there's a question on valuation. Can you elaborate on what drives D2C brand valuation?
Right. I'll start. You can chime in, but it's pretty straightforward. It's size of market, it's growth rate, it's margin profile, and also strength of entrepreneurs.
Yep. And the only thing I'd add on that is if you're the leader, I do think there's ultimately a pretty big premium put on the leader in a category.
I agree.
Great questions.
Given the focus on inflation risk in the future, you can all read the question. Are you seeing any additional interest in companies in your portfolio that are inflation sensitive?
Yeah.
Inflation sensitive.
Yeah, one of our arguably inflation sensitive businesses is ironically Picasso, because it's so tied to people feeling like and knowing they can get these 2.5% fixed interest rates buying their second home. I think it'll be a while before it impacts that, but that certainly could have an impact. For whatever reason, when you just think about the all the talk of inflation, I know some numbers came out in the last couple of days, but of my fears at the moment, I just don't see runaway inflation being a big issue in the near term, and certainly not impacting early stage tech companies materially.
So Brian, when you're looking at the market right now, what excites you and what concerns you?
There's a lot of things that excite me. I'm easily excitable.
We're talking about the e-commerce market, Brian, please.
Yeah. I'm super excited about e-commerce. I think there's a tremendous amount of innovation being had. Still, absolutely.
You're one of the founding pillars of this industry, and you're still excited about it.
Oh, absolutely. I mean, every day, I get pitched by 5 to 10 new companies that don't exist, and they're working on something super cool. Right. So very similar to Brad, we saw Pop Shop Live, we saw Whatnot, we saw a bunch of these kind of live commerce sites, and I think it'll be a horse race, but I think someone wins that game. They're going to have to compete against Amazon and eBay and everybody else as well, who are going to take a swing, and Google. But that's incredibly exciting to see that play out. Headless commerce, as Brett mentioned, I mean, there's a lot going on in that space, just a tremendous amount. I think there's a lot of ancillary technologies that help commerce. So companies like Emotive and Instinct and some of these companies that are helping convert consumers on your website, I think are super exciting. I think fintech is really exciting, right? I think fintech really is helping boost e-commerce in tremendous ways, right? From everything from the Afterpays and Affirms and Klarnas on the delayed payment side versus daily pay and some of these other companies on the pay now kind of world and turning people into the gig economy. It's an exciting time to be in e-commerce. There's a lot going on.
Brett, what is concerning you? What is exciting you?
What concerns me is I do think there's too much capital in the system, and I think valuations generally are skewing too high. What excites me is so far that thesis is not correct. that if you look at if you say the ultimate barometer of value is when these companies get public and when society gets to decide on the actual value, right now the system is working. These businesses are going public, and obviously there's exceptions, but generally they are working and succeeding as public companies, and they are in lots of cases worth 2 to 3 times more in the public markets than they were even in the private markets. So
Brian, there's a question about when you invest in a company versus when you bring a company in your studio or start a company in your incubator. What's the big difference there?
Well, we never bring in outside companies into the studio.
Oh, they're
Uh,
all yours, right?
They're all my own ideas, yeah. So we're not a traditional incubator or an accelerator in that fashion. We don't have cohorts and so forth. It really is more of a production studio where I'll come up with an idea, I want to launch it, so I'll build a team and get it launched. So it's a little bit different.
Wonderful. So, gentlemen, oh, hang on. There's another one. Share 2 or 3 of your biggest red flags, warning mistakes you made in the past couple of years, and if you could undo it, if you would. And we'll consider it one of the last questions, as I want to remain on time with our dear friends here, as they've been so generous with their time, advice, and insight. So, Brett, you first.
You got it. Yeah, I think the consistent mistake that at least I've made and venture capitalists make in general is really amazing idea, building into a great market, and you know it's a subpar team, but you decide to make the investment anyway. And it's very tough to talk yourself out of it, but virtually every single time it doesn't work out. So when you come to that roadblock, pass on the deal. In this business, it is literally all about that team.
It's all about the team. And Brian?
Yeah, it's the same lesson. You should share it with Brett. But yeah, it's the same thing. For us, it has to be a very, very strong founding team. And the mistakes that we've made is exactly that. I mean, we invested in a company that didn't even have a CEO because it's a long story. But you know, if we could unwind that, I would. You know, it's number one, invest in companies with a CEO.
Yes.
Yeah. So, but really, it's about the founding team and the strength of that team.
It is always about the team, and that's what I've always believed in. So we always start with team and then everything else. So, gentlemen, I want to thank you again on behalf of obviously myself, everyone at TCA. You are dear friends. You're very generous with your time, with your insight. We really appreciate it. I'm honored to be your friend, and we thank you so very much. Brian, if people want to reach you, is it all right if they contact you via email?
Sure, of course. Brian at bam.vc.
Brian at bam.vc. Everyone at TCA, thank you very much for your participation. Sunny and Arash, thank you for setting this up. My name is Ivan Niku. My email is ivan@navigatevc.com. If Brett, Brian, or myself can be of any assistance in any way, we'll be more than glad to respond to you. Thank you, everybody, and good night. Bye-bye.
Thanks,
Thank you,
TCA.
everyone. Thank
Yep.
you.
Great panel.